It's almost a mindset, right? Do you start with nothing and then figure out how you would add in a very small number of stocks? Or do you go literally the opposite way, which is I'll start with everything and then I may want to refine based on research, based on expected return, based on, different preferences. That's fine. But those are two sort of philosophical views on how you might want to approach it.
Yeah, give me a reason not to hold this.
Welcome to The Informed Investor, where we break down the latest financial headlines, bringing in research and insights to help you separate the news from the noise.
Welcome to The Informed Investor. Today we are talking how many stocks you need in your portfolio. The show is brought to you by Dimensional Fund Advisors, who is bringing financial science to investing. I'm Mark Ochner, and I'll be joined today by the dynamic duo of Jake DeKinder and Wes Krill. Good to be back on the show.
I'm excited to be here. I thought for a second you were going to call me Jake and him Wes.
I was kind of looking at you when I said Jake.
I mean, you did get in late last night, so I wasn't, a little tired. But I feel like we've talked about this topic, though, before. I'm excited
It does
for
seem eerily familiar.
Yeah.
It is a great topic to talk about. I'm going to start with some headlines. Are you over, under, or perfectly diversified? Over diversification, how much is too much? Jake, I think you are probably perfectly diversified.
You mean with my investments or in life or
Investments.
what?
I got
I'm not going
99
into
problems
personal life.
and diversification is not one.
All right, let's talk a little bit about how many stocks do I have to have in my portfolio. Now, I went to the source to start this out, and then we'll come to you guys. I went to Chat GPT, and here was my question. How many stocks do I need to own to be diversified? The answer, 20 to 30 stocks. You capture most diversification benefits. 30 to 50 stocks, diminishing returns. Risk reduction barely improves beyond this point. How do you feel about that, Wes?
It's just funny because you would have thought this was a settled argument like 60 years ago, where we had this emerging concept of Markowitz and modern portfolio theory, where it suggested that you would want to have the market. And these days, when you can access the entirety of the market, I mean, over 40 countries around the globe, more than 10,000 stocks out there just on the equity side, you can do it very inexpensively, very easily, in high liquidity fashion. So it's not really clear why you would not want to have as broad of diversification as possible.
I'd agree with you on that. I mean, it's almost like, to Wes's point, it's like Chat looked up articles from the birth of modern finance, right? Which was almost like just a basic math problem, but there was so many other things that they were failing to take into consideration. Also, the evolution, to his point, like think about where we were 60 years ago and where we are today, and the opportunity set for investors. I mean, it's just absolutely remarkable what you can do in a low-cost, broadly diversified, 40-plus countries allocation. So it's weird that still, when you look that up on Chat, that it's directing investors to, you need 30 stocks.
But if you go back, I started Dimensional, almost 28 years ago, and taking the CFA. You've taken the CFA, and you've probably had it in a lot of your different studies. I mean, that was a big part of the curriculum, was how many stocks do you have to own, and it was 30 names. And so it wasn't that long ago where that was kind of the prevailing view, but that's where they're defining risk as standard deviation, right, Wes, where they're saying, hey, in 30 stocks, your standard deviation can be, making up numbers, 14.8 to 15.2. Like, it's not meaningfully different if you add another 500 stocks to that.
Yeah, I mean, it's certainly not a number they're pulling out of the hat. It's like if you were to simulate different strategies and add stocks sequentially and just plot out where their standard deviation is, it becomes kind of asymptotic or starts to level off once you get to 20 or 30 stocks. I know I probably shouldn't have used that one. You guys are make fun of me more later.
You looked at me.
Can you define that for me?
Not a chance.
I have no idea what that
It
means.
levels off, like they say. But I think, to your point, it's a very, what I'll call, overly simplistic view of diversification benefits.
Well, that was my point of what I meant by it's a math problem, right? Which is, if you take a very basic view, you work with this opportunity set, you look at it this way, and you say, if I go from 30 to 50 to 70, there's sort of this decreasing benefit around standard deviation. But again, that's the point of, it's a very limited view of what you might want to think about as an investor.
Well, you go back in time too. It was much more expensive to go out there and transact in stocks, right? The spreads were a lot higher. You had commissions that were really, really high. And so maybe that was part of it, the expense of it. So you did want to narrow your number of holdings. But let's run with that for a minute, just on the 30 stocks, and just think how crazy that is really for a strategy.
Yeah. Well, if you have over 40 countries in the world, so I'm not a math major, but I think that implies that in a 30 stock portfolio, you can't have one in every single country. So you got to say, okay, which countries am I going to pick? Which countries am I going to exclude? I mean, even in developed markets, the average return spread between the best performing and the worst performing country is over 50%. So that means there is a pretty big opportunity cost for getting it wrong. I mean, last year, if you had to choose between, let's say, Denmark and Spain, which one are you leaving on the table?
Denmark. I'm taking Spain.
See? This is the expert at market timing right here. You chose it based on the food, didn't you?
I did. And what do we say before the beaches, too?
The beaches, yeah. Not a lot of good beaches, presumably in Denmark.
Yeah.
But, and you got the call correct, by the way, because there was a difference between, having a negative return and over 80% in the case of Spain, the best performing developed market last year. So the point here is that, the diversification, okay, it sounds good in theory that you're going to level off your volatility for a simulated strategy. But if you have to start picking countries, let alone sectors, even within a sector, the individual companies, which you can have big variation. Even this year with Mag 7 and Q1, I mean, there was enormous return dispersion between the best performing and worst performing. So that's a lot of things that can go wrong when you start to narrow it down to 30 stocks. And for what?
It's like, you're going to answer your own question.
You guys probably don't.
I was waiting for it.
You probably don't remember Ricky Waters, a football player back in the day.
I do remember Ricky Waters.
He'd say basically for who, for what, when they were asking him why he didn't take a hit from a defender.
Oh,
yeah.
Okay.
He's in it for himself.
I love the little history lessons you bring in. But actually, I mean, it's a great point. Think about that. I'm just going to say 10,000 plus stocks around the world. We know there's even more than that, right? And you're like, okay, so I'm going to pick 30 of them. Like, really think about that. And what you're actually setting up is you're setting up traditional active management right there. And you go back to the very first studies that were run on traditional active management back in the late 1960s. And what you saw is that it didn't outperform, right? And all the way through as the studies continue to go on. So, I mean, not only do we see the evidence, but really just think about that logically. Like, what countries are you going to invest in, what sectors, and when are you going to get rid of those companies as well? That's an important point, right? So you got to dump some and then buy some new ones.
Which one are you going to pick?
Exactly.
And then for how long? So let me give you some numbers here. And I'm just going to run with kind of what you set up there is to say, all right, I got to pick a country.
Yeah.
Maybe not all of them, but I got to pick one. Well, okay, I have my country. Now what? Do I just pick one stock within that country? So here's one recently for China. China, this is year-to-date returns through April, US dollar. China's down 6%. Yet you think, I'll just go get a massive company within that marketplace that'll represent generally the Chinese stock market. So I go buy Tencent Holdings. Well, that happens to be down 22% in the first 4 months. So the risk of getting it wrong is massive. And then going back to your point, then, okay, well, what if I look at a sector? Okay, which stock within a sector do I buy? So this is going to be a little bit longer run time period here. But if you go 10 years, let's say you just go get a tech stock 10 years ago. NVIDIA, I could have picked them. They're up 72% annualized over 10 years, which is a crazy annualized number. Or Intel, up 15%. Netflix, up 26%. Disney's up 0.9%. So, I mean, the risk of getting things wrong, whether it's a sector, whether it's a stock, whether it's a country, is massive in a small number of holdings like that.
Well, and we haven't even really brought in the idea of implementation. When you really think about that in terms of like super small number of names versus more broadly diversified. And when you start thinking about that of how would you actually manage a fund and would you want to have flexibility when you have to go to market and buy and sell stuff? So I think, again, going back to some of those original studies, Markowitz and all that of the 30 stocks is that, I mean, that kind of leans towards that academic side, right? Like there's a reality of managing money in the real world, and broad diversification can help you tremendously with that.
Yeah, I mean, we've just been talking about the returns of the securities and standard deviation, but there's other elements of value adding potentially bring to the table if you don't have diversification constraints. We've talked about securities lending many times on the show, and you don't know always which companies are going to deliver the highest securities lending revenues on into the future, and oftentimes it's very small companies, and sometimes they are from sort of less liquid markets like emerging market countries. So again, the more constraints you have in your process, that's not to say that everyone should be holding every single stock in the market. I think we can probably think of some examples where you would want to exclude some of the securities from the overall market, but having unnecessary constraints in play can really limit what you're able to do from implementation and return standpoint.
It's almost a mindset, right? Do you start with nothing and then figure out how you would add in a very small number of stocks? Or do you go literally the opposite way, which is, I'll start with everything, and then I may want to refine based on research, based on expected return, based on, different preferences. That's fine. But those are two sort of philosophical views on how you might want to approach it.
Yeah, give me a reason not to hold this.
Yeah.
Well, expand on that. So let's talk about some of those stocks that you may want to remove from that opportunity set. Maybe there's some with lower expected returns. Tell us a little bit about that.
Yeah, I mean, we have decades of evidence that, especially in the small cap portion of the market, companies with high valuations and lower profitability, or ones with very high balance sheet asset growth year over year, these have lower average returns. We also expect that based on their characteristics through valuation theory. So that suggests that there is going to be a subset of stocks that we are willing to, if you call it giving up some diversification, we're willing to exclude them in the pursuit of higher expected returns. And I think it's important to think about that is, what is the goal of this investment solution? And, once you have the goal, that can dictate how much, or if you want to deviate from the overall market portfolio.
I mean, the idea of sort of, do you give up diversification? Do you think, all of these things are sort of saying, what are the trade-offs that you're weighing there? And I think, the challenge again with a super concentrated portfolio is, look, if you throw NVIDIA in there and you get it right 10 years ago, guess what? Your concentrated portfolio is going to look really good, barring maybe some of your other ones not doing so well, right? And so, you're almost like swinging for the fences, and maybe it pays off. But what we know in terms of the evidence, that's a really, really hard route to go. Whereas again, doesn't mean you have to own every stock in the world. There are trade-offs there, but you may want to think about swinging a little bit more towards that broadly diversified versus I'm going to take a flyer on a couple stocks.
So let's run the evolution of that. So that was a pretty common theme back in the day, to invest in just a small number of names. We talked about some of the limitations of that. So that led to then this idea of, well, let's just expand the opportunity set, but not buy everything, right? So maybe we start sampling. You see that a lot in index funds where, because it still can be costly to go buy everything, right? So they may perhaps say, oh, I'll just buy a subset of that. Or you see other managers perhaps buy a subset of sectors and things. So let's talk about then some of the trade-offs, as you alluded to there, of a sampling approach.
Yeah, well, that's where you get into the operational constraints of it. So again, with an index fund, if you have sampling or basically selecting stocks almost at random from these countries, and you could miss out on the ones that deliver the return premiums from those countries. We had an experiment we looked at where over the last 15 years, if you missed out on the top 10 return contributors each year in the global equity portfolio, dropped your return from a little bit over 10% to about 7%. So there is a big potential cost to pay there. And then if I'm a traditional active manager, well, I might have constraints in my process just because of my investment philosophy, where I'm not going to hold everything out there in the marketplace. So again, you think about what those two investment styles are constraining you with. Well, having flexibility in your investment process is really a key here, because then I can access all of these different countries, thousands of stocks, in a way where it's not imposing excessive costs on my portfolio.
I love the point that Wes brings up there. When people are like, oh, the market did well. It's like, guess what? A subset of stocks did well that drove the market return. And that even goes down into, as you start thinking about the premiums, which we've talked about, size and value and profitability. When someone's like, oh, value did well, I'll be like, it's a subset of value stocks normally that did well that drove it. It's a subset of small. So it's really a question of, if we know that's what we've seen from the evidence, do you think you can pick the ones ahead of time that are going to deliver it?
Think about then, if you say, okay, start with that one idea you guys had. If you start with the entire opportunity set, let's call it the market. Maybe you overweight certain stocks that have higher expected returns. Maybe exclude some of those that have very low expected returns, like you said, with low prof stocks or perhaps high asset growth stocks. But then with that set, you want to buy them all, because a couple of things that jumped out where you guys said. One, it gives you a lot more flexibility in your trading. To manage your trading, you'd be more flexible around that. It gives you flexibility on securities lending revenue, right? Where maybe some of these smaller stocks is really where you earn the revenue globally, particularly in a lot of other countries like emerging markets, can be big. And I think about it too, depending how you want to phrase this thing, but it either, by owning all those stocks, it reduces the chance of underperformance, because you may, if you're sampling, I might not get the stock that did really well. To your point that usually a subset of stocks are the ones that drive the market. I guess the other way to think about that is you're increasing your odds of outperformance by having as broadly diversified portfolios you can get.
Yeah, even if you preserve your expected return, and we've run this kind of research experiments before, but even if you preserve the expected return at the same level, but you're forfeiting diversification through sampling, what you end up with is higher tracking error. Or return deviation versus the benchmark. And so that means, to your point, you have a higher probability of underperforming over any time horizon. And so again, it's another thing you're forfeiting when you don't have to. You generally, especially if you have flexibility in your investment approach, you don't have to forfeit all these companies.
Well, and it's interesting you bring up sort of tracking error, tracking difference, right? And I don't think people think a lot about that of, okay, I'm seeing the broad market do X, and if my portfolio performance is higher or lower a lot of times, right? What are we getting at there? Now we're talking about discipline as an investor, right? And this is a really important concept as well of like, yeah, guess what? Maybe you hit a home run, right? But if you've got sort of more variation, you've got more tracking error, you're thinking about all of these things, right? You got to think about, okay, can I actually stick that out as an investor? And that's a lot of conversations we have with financial advisors and financial professionals where they're weighing all these trade-offs around expected returns, but also deviation from quote unquote the market, because at the end of the day, you got to keep people in their portfolios.
I think about the risk side of things then. If you go back to those original studies, like the 30 stock portfolio, that was all about standard deviation, which is one measure, right? That's just about the volatility of the portfolio, one measure of risk. But you go back to what are the other risks perhaps for investors? You talked about one, tracking error.
Mm-hmm.
Do I have the mental aptitude, the discipline to stick with it in case if I'm underperforming the market? It could be outliving my money. It could be certain goals you have in retirement, standards of living you want to maintain. I mean, there's all kinds of different risks out there than just standard deviation, which comes into play.
Yeah, I'm glad you mentioned the risk management aspect of it, because this is where I think you see a little more explicitly the trade-offs between your goals and the level of diversification. It's easier to see it there because let's say I'm saving for a near-term cash flow. And let's say I'm saving for down payment for a home in the next year. Well, that implies that adding maybe a whole bunch of longer dated fixed income strategies to my portfolio are not going to increase my reliability of hitting that goal. In fact, they might actually detract from my ability to meet that goal. And so in that scenario, I am willing to forfeit the potential benefit, diversification benefit of having these longer dated bonds so that I can increase the certainty of hitting my goal. So, again, you go back to what is the goal within the constraints of that goal or within the definition of that goal. I want to be as diversified as possible, but that means that not necessarily adding more and more stuff that's inconsistent with my goal is going to be helpful.
Well, talking about adding more and more stuff, we've seen over time that people will throw a bunch of different funds together in a broad allocation and not really understand what's inside of those funds. And so a lot of times at the end of the day, you're like, all of these funds or a lot of them own a lot of the same stocks. So you're getting at what your goal is in a really inefficient manner, and you have this crazy overlap. You got to understand what's actually inside of your funds, and you got to understand how those funds fit together in a complete allocation.
Yeah, you hear, well, I'm diversified. I own 10 different managers. Yet those 10 managers own the same stock.
They're all holding Mag
really
7.
They're all Mag 7 stocks.
Okay,
right?
listen, go back to the founding of Dimensional. When David and Rex go out and talk to these big institutions, what they found is a lot of them had 10, 15, 20 managers, whatever it was. And they're like, yeah, all you guys own the S&P 500. You're literally just trading with each other. Wouldn't you want to own some small stocks there? So, and again, that's not a fault of individual investors. You see it sometimes with some of the largest institutions that might be out there. So you really got to understand what's under the hood. What does my diversification look like? How do these things play together? And again, role of the financial professional, and I mean, hugely valuable in what they do.
Hey, we're talking about stocks most of this conversation. Let's go back to the bond side of it. Wes, you brought that up a little bit there. How do we think about number of names within a bond portfolio? Does it matter there how much you're diversified?
Well, that's where, in the example I was using about near-term cash flow needs and the volatility of the portfolio where, shorter dated, like having a focus on shorter dated bonds of high credit quality might be sufficient to satisfy that goal. I don't need to add lower tiers of credit quality. I don't need to add longer dated bonds to the portfolio. I already have something that's helping me reliably achieve my goal and expectations. And so the other stuff might, if anything, be counterproductive. Even if you think about, like if I have a portfolio that is focused on U.S. government bonds, well, adding a whole bunch of different securities that were issued by the U.S. government might not be additive there. It's different if it's a corporate bond portfolio where you might want to have lots of different issuers in there for diversification. But then if I get 15 different bonds from GE, does that make me more diversified than I was before? Or if I add in bonds from additional companies as well. So you have to think about whether you're actually additive. And it's exactly like analogous to what you were saying, which is if you have a whole bunch of different portfolios, but they're all holding the same stuff, I'm not increasing my diversification. I'm just increasing the cost and complexity.
So almost similar on the bond side. Start with your opportunity set and then reduce depending on what your objectives are.
Yeah, with bonds, I think it's a little more crystal clear just because bonds tend to be the risk management tool in your portfolio. And if you have risks that are well specified, which many of us do in our everyday lives, then the appropriate asset class is more well crystallized. And then once that's the case, then you kind of know what the level of appropriate diversification is.
Well, it's also on the implementation side, it's really similar, right? If you do have that broad diversification, then you have more flexibility around the stuff that goes in and out of your portfolio. That can add value as well. So there's definitely differences between the stock and the bond market, but a lot of those concepts carry over.
All right, so let me summarize here and almost go back to the beginning of the conversation, which is sort of the evolution of this notion of diversification, where it started out with a 30 stock portfolio based on 60-year-old data and research. It's evolved into sampling, which I would go back to say that is still a suboptimal solution, because it doesn't give you as much flexibility as you can in the way you implement. So probably depending on the objective of the portfolio, you want to diversify as much as you can. That's how I think about the conversation here today.
I think that's a really good starting point. Again, it's, do you start with nothing and add in? Do you start with everything and then potentially trim from there?
I keep thinking about the story you were telling about the origins of the firm, where 45 years ago it was sufficient to make the argument about diversification to the point where they were even willing to tolerate the underperformance of the asset class. And now we have some people saying you only need 30 stocks. It just kind of feels like missing the point.
All right, last thing here, as I look at your list there, Jake, in your notes, is that like your shopping list of, hey, I got to buy flowers on the way home, I got to get pet food?
It definitely could be. Actually, every single episode I walk in, I just write a couple of things down, which is markets work, risk and return are related, and diversification is your buddy. Just keep those things in mind. You'll probably be just fine.
We should make a statue, or not a statue. We should make a little poster of that in the back here. Those are awesome concepts to always keep in mind. All right, the dynamic duo. Thanks, guys. That was a fun conversation.
Thanks for having us.
Appreciate it here today. Thanks to all of you for joining The Informed Investor. We appreciate your time here today. Be sure to check out a newsletter from David Booth, who is our chairman here at Dimensional. It's called Stay Calm Investing. You can access the link there in the show notes. And with that, have a fantastic rest of the day. Thanks for joining.